to this Thursday edition of Inside India. I'm Sri Jegarajah. Your headlines. President Trump confirms 50% tariffs on copper will take effect on August the 1st as his next batch of tariff notices goes out. Brazil getting hit with a 50% rate. And ready for launch, Elon Musk's Starlink has reportedly cleared the final regulatory hurdle in India, paving the way for it to enter the South Asian market. And India's petroleum minister defending his country's Russian oil purchases as the US considers fresh sanctions.
If people or countries had stopped buying at that stage, the price of oil would have gone up to $130 a barrel. That was the situation in which we were advised, including by our friends in the United States, to please buy Russian oil, but within the price cap.
Welcome to Inside India this Thursday. Let's first of all start off the programme by taking a look at the picture in the Asia-Pacific markets, which are rising in the main with a few exceptions. So all in all, investors seem to be looking past this latest barrage of seemingly negative headlines on the tariff front from President Trump and the administration, and instead looking towards Nvidia as the positive lead, as the positive catalyst, as it became the world's first company to hit a $4 trillion market valuation. Indian markets join us in about 45 minutes' time. Here's what GIFT Nifty futures are indicating for open, 25,554. So it seems to be pretty range-bound in this area of 25,500, so little changed compared to where we left off yesterday. Dollar-rupee exchange rate at 85.58. More tariffs to come on August the 1st. President Trump has confirmed that America's 50% tariff on copper will take effect on August the 1st, alongside other reciprocal US tariffs. He says the move follows a security review as the US pushes to bring more manufacturing back on shore. Copper exporters in India took a beating in yesterday's session, with Vedanta and Hindustan Copper losing over 3%. More tariffs, but still no new deals. President Trump rolling out more letters to trading partners. Brazil now in the crosshairs with one of the steepest tariff rates yet at 50%. President Lula says Brazil will hit back. CNBC's Megan Casella has the details.
President Donald Trump late on Wednesday sent his 22nd tariff letter this week, this time to Brazil. But this one was different from all the rest. The president is threatening to levy the steepest tariff we've seen so far this week at 50% on all imports from Brazil beginning August 1st. It's also the first country to receive a letter that was not previously set to face a so-called reciprocal tariff. The U.S. runs a rare trade surplus with Brazil, so there's no deficit to fix here. In the letter, President Trump says the tariff is in part due to Brazil's treatment of former Brazilian President Bolsonaro. He calls it a witch hunt, and due to what Trump calls insidious attacks on free elections and the free speech rights of Americans. Trump also says in the letter that in addition to the 50% tariff, he's instructing his U.S. trade representative to launch a Section 301 investigation into Brazil. That will look into unfair trade practices, specifically over digital trade, and that could lead to further tariffs down the road as well. So this is new territory on trade for President Trump. Tariffs against a country the U.S. runs a surplus with over political reasons, not economic ones. Brazil is in the U.S.'s top 20 trading partners, but it's not huge. About 1.3% of all U.S. imports come from Brazil. Earlier on Tuesday, the president also sent 7 other countries' tariff letters, all to countries the U.S. does very little trade with. Those all matched the same format as earlier letters, and that batch of countries included the Philippines, Iraq, Sri Lanka, all of them now facing tariff rates between 20 and 30% on their exports to the U.S. because of their trade deficits, unless they strike a deal by August 1st. Megan Casella, CNBC Business News, Washington.
Thank you, Megan. Meanwhile, remember, Trump is also targeting the pharmaceutical sector. Stocks in India traded mixed after the US president warned that duties on pharma imports could rise to as much as 200%. Dr. Reddy's, which counts the US and Canada as key markets, was the biggest loser on the board. Many other Indian drug makers see the US as their largest overseas market, with nearly $10 billion worth of exports in FY25. In the meantime, some companies are turning to India to dodge US tariffs. South Korea's Samsung Electronics says it would be ready to shift some production to its India plant from Vietnam for shipments headed to the US, but only if India's tariffs stay lower. Speaking on the sidelines of the launch of Samsung's latest foldable smartphone, the company's mobile division president said they are watching Trump's tariff announcements closely and are ready to react flexibly. Let's get more analysis with Sumedha Dasgupta, senior analyst at Economist Intelligence Unit. Sumedha, thank you very much indeed for joining me on Inside India. President Trump seems to be shifting his strategy, doesn't he, and now targeting BRICS nations, first with a 10% BRICS tax and now 50% tariffs directly on Brazil. Could India be next in line for this treatment if market issues for agriculture, which we know is a red line for India, continue to prove a roadblock for a trade deal?
Thank you so much. Yes, as you very correctly said, President Trump seems to be targeting the BRICS nations quite inordinately due to geopolitical agendas. And of course, agricultural market access is something that India will be very, very reluctant to provide, not just to the US, but India has hesitated in opening up this sector even in previous trade deals. For example, with Australia, it is now negotiating trade deals with the EU and New Zealand, where again, this sector is off limits. It's a political minefield, so no government worth its salt is going to open this up because it is a huge employer and many of the sectors are cooperative run. Now, whether President Trump is actually going to use the same kind of stick approach for India just because it is a BRICS nation is actually not something that I expect, largely because of the Indian market. The vast Indian market is something that the US will not want to lose access to. India originally had a conciliatory stance, but we have seen that it's hardened its stance quite a bit, some of it to do with geopolitical developments over April and May. As a result of which, India will also take a hardline stance and retaliate if sort of BRICS levels of tariffs do come through to India. So I don't expect that President Trump will actually do this. This is more rhetoric than anything else.
Understood. Sumedha, and domestically, we've got to note that the rural economy and Tier 3, Tier 4, Tier 5 cities are currently performing quite strongly. So India would not want to put that in jeopardy, would it, under a US-India trade deal that potentially lifts restrictions on market access for US farm goods?
Exactly, that's very correctly put. So yes, a lot of these smaller, lower-tier cities, the rural areas, they depend on farm goods, the agricultural sector, the dairy sector for their livelihoods. This is, as I mentioned, a very important sector. So opening up that sector to competition, which is a very, very important ask from the US government side, is something that India will absolutely be unable to do. There are, of course, some specific areas, for example, fruits and nuts, these kind of things, where India has already made a lot of concessions and said that it will slash tariff lines. But the more important ones on food grains like rice, wheat, maize, and dairy products, genetically modified crops, these are areas where India is extremely reluctant, and a lot of livelihoods are at stake. Competition within the domestic market is at stake, and the agricultural sector, as we've seen in the past, is something which makes the government walk back on a lot of policy reforms. So even if the government does agree, there will be a lot of widespread protests. So naturally, this is not palatable for the Indian government.
It really does feel, doesn't it, Sumedha, that there's a rising list of really divisive and controversial areas. So is a more likely scenario then to kick these more challenging issues like ag, like steel and autos down the road to October and agree to ease market access for a select few agricultural products and a select few areas, and not areas like dairy and genetically modified grains that have proved so contentious?
Yes, that is exactly what I actually believe will happen. So we've had this forecast for a long time at EIU, and we do expect that the short form trade deal or the early harvest trade deal, which is what we expect will be inked over this month, is actually not going to tackle these difficult issues. These are going to be sort of kicking the can down the road to later this year or early next year when the full form BTA is going to come through. There are a lot of other challenging issues also that India and the US need to discuss. Visa related differences, data localization, other kinds of tariff reduction, market access, disputed subsidies, all of which are possibly going to be part of a long-form trade agreement. The areas that they can agree to at this point of time will probably come through in over this month in the form of an early harvest deal. There are quite a few areas where actually there's been progress, but yes, we do expect that there's going to be a lot more that's going to come through later. Yes.
So, is there a non-trivial risk that a full and final BTA won't be ready, Sumedha, by the end of the year? And if that somewhat negative scenario does materialise, what would be the impact on India's economy and headline growth of 6.2%, 6.5% for the current fiscal? Is that going to be in question?
Yes, I would say there's actually quite a significant risk of the BTA not manifesting by the end of this year. So as we know that US and India had an autumn deadline, and that's what they're working towards. But especially given issues on US government staffing and the fact that they are working on a number of competing trade deals at this point of time, it obviously means that negotiations are going to be stretched. As I mentioned, many of these areas are extremely difficult, so which means we are unlikely actually to see a full-form BTA come through by the end of this year. If negotiations are abandoned altogether, which is what you're saying, or if the tariff narrative is ratcheted up, let's say, in that case, definitely there's going to be a greater impact on the Indian growth story. So we're going to see a lot of slower hiring. We're going to see very less capacity addition, low FDI coming in, these kind of things. So that is going to knock down the GDP significantly, maybe even below 6%. But much of that will come in the next fiscal year. We'll see the impact of it then. But yes, that is certainly not a non-trivial risk, yes.
Sumedha, what then are the longer-term implications for the economy, and especially the structural changes that India is looking to implement under Viksit Bharat, the aim to become a high-income country by 2047, is opening up international trade on terms and conditions, of course, that are favourable for India and in India's national interest. The catalyst that India needs to develop and to move towards this developmental goal, especially this move up the economic value chain towards advanced manufacturing.
Yes, this is absolutely something that's been happening. India is notoriously protectionist, as we know, but over the past couple of years, India has been working very hard to shed this protectionist veneer. It has inked a number of trade agreements with Australia, with the UAE, with the EFTA. It's in the works with many other countries, as I mentioned. So India is working hard on getting a lot of bilateral trade agreements done. India generally eschews multilateral ones, largely due to dumping and employment concerns, but bilateral ones are being worked on, as well as the fact that the government is working a lot on lifting domestic-led levers for growth. For example, infrastructure is a major one. There's been significant improvement on that visible over the past decade. This process is going to continue. Along with that, advanced manufacturing is, of course, something that the government is looking at, but the production-linked incentive schemes, for example, which are implemented in 14, 15 sectors of the country, also look at a vast range of manufacturing, labor-intensive ones, capital-intensive ones, all of that just to boost that, because India has kind of made the jump from agriculture to services, sort of evading the industry segment. And this is now being worked on very hard by the government. So definitely that's going to be an important area to watch for, which will sustainably raise growth. And India is a very insular economy. It depends very much on its own domestic demand rather than environmental headwinds coming in from abroad. So that's also going to be very key and important to keep India's growth very strong for a major economy.
And will opening up trade and FDI help resolve India's structural issues and challenges surrounding job creation? And will that lead to higher long-term employment ratios?
Yes, we've seen a lot of shift in the FDI structure, actually. So if you look at a longer time period of about 15, 20 years, initially all of the FDI, of course, came into services, IT, these kind of sectors. But now there's significant FDI that's coming into infrastructure, into telecom, into energy, automotives, these kind of sectors, which are very key sort of manufacturing sectors in sectors for India. So we are likely to keep seeing this trend. As I mentioned, India's vast population, large market, strong growth, these are very attractive features for foreign investors who are looking for these kind of things elsewhere. And generally, in a situation of geopolitical turmoil, India is placed a little bit better than, say, some of the ASEAN countries, which the US, for example, perceives as a connector network from China, these kind of things. So India is generally shielded from that. So certainly these factors are going to keep FDI very strong, momentum very strong for India. And this, as we know, is, of course, a knowledge transfer mechanism, leads to much better longer-term growth, which is also what we do expect.
Sumedha, ultimately, does the Modi administration risk a domestic backlash here and the unrest that we are arguably already witnessing, and that's already underway, given the nationwide Bharat Bandh protests that are happening right now? Does that worsen, especially if there is a deal, or India is perhaps forced into a deal by the US that may be not in its best national interests?
Well, we'll really have to see the nitty-gritties of the deal, won't we? But if we do look at a couple of sectors which get reprieve from a US trade deal, even if it's a short-form trade deal, that is significantly good for the economy. I don't actually expect anything on the agriculture or the dairy front to actually be opened up very significantly. This is a pressure that India will resist. But if, as you said, it is forced, for example, to do this, which is a very, very actually small risk. But if that does happen, yes, we do expect much more sort of protests to come up. We've seen a lot of that in 2021, if you remember, with the farmer protests when India tried to introduce agricultural reforms in marketing. But we are likely to see those kind of things happen again if India is forced to give some leeway on these things. But again, as I mentioned, this is a political minefield. No government which intends to stay on in power is likely to do this. We have to remember that the coalition government is not now just the BJP. It has other factors, other members who are very important, and they are needed to hold on to the regime. So therefore, it's very important that these things are looked at by the BJP. So there's a very low risk of agriculture actually being opened up. So, but if it does, yes, protests are definitely then on the anvil.
Sumedha, we'll leave it there. Thank you very much indeed for that analysis. Sumedha Dasgupta there from Economist Intelligence Unit. Coming up on the programme, Elon Musk's Starlink could soon launch in India while its biggest rival in the country is pulling back from public markets to focus on growth. We'll bring you the details after the short break. Welcome back. We do want to show you shares of Nvidia in case you missed it. The AI chip darling going where no company in the world has gone before, hitting $4 trillion in market cap overnight. Finally ended the session up 1.8% and a $3.97 trillion market cap. Take a look at how far the stock has come. 10 years ago, it was a mere 50-cent stock. So if you had bought into Nvidia then and held on, you'd be in the money to the tune of nearly 33,000%. Back to India, let's talk about one of the most anticipated IPOs in the market. Reliance Jio is reportedly pushing listing plans. Jio was expected to debut in the markets this year, but now Reuters reporting that the company wants to grow the revenue and subscribers in its telecom business before making a public offer. Billionaire Mukesh Ambani-led firm has been valued at over $100 billion by analysts, and it could be facing stiff competition from Elon Musk's Starlink that just got the final nod to operate in India. Indian Space Regulatory Agency reportedly providing Starlink with a license to launch commercial operations. Starlink got approval from India's telecom ministry last month. And despite Jio pushing its plans, India's IPO market is getting hotter. Institutional buyers snapped up the public offering from airport and lounge operator Travel Food Services. The $234 million IPO was subscribed about 3 times overall, though retail bids came in at just 0.7 times. It is India's 9th largest IPO this year, with the company targeting a $1.7 billion valuation. Shares of Travel Food Services will begin trading on Monday. Staying with the IPO theme, Singapore state investment funds Temasek is also finding India's IPO market open. Temasek's annual portfolio value hit a record 434 billion Singapore dollars. In the last year, Temasek's exposure to the US and India rose, while exposure to China dipped slightly. Fund also posted strong gains across portfolio companies and direct deals in the US, China and India. Martin Sung spoke to Temasek's chief investment officer about their India investments.
I would say even the public markets, look, we're talking about the last few months, it having maybe not performed as well as some other markets. Yeah. But if I look at any longer term period, the Indian market's been one of the best performing markets. Foreign money, actually the reliance on that has gone down a lot in India because you have such large domestic flows. So if you look at the fourth quarter of last year and early part of this year, the outflows we had for foreign money were tens of billions of dollars out of India as they reallocated to other places. And in the 10 years ago, that would have had a huge negative impact on the market. I mean, this time it had barely a high single-digit impact on the market. Because ultimately, we have a lot of domestic flows, almost $3 billion a month of retail money coming through systematic investment plans, pension funds, etc., who are increasing their allocation to equities. So it's almost $50 billion of years of domestic flows that are coming in on a regular basis. Okay. So long term, even the public markets, I would say we're quite positive on India. And foreign money will come in and go in waves. And actually, when it does, it will create significant upside in the market.
What about their private markets, though?
Private markets continue to see opportunities. India is one market where actually exits have been much easier for private companies because the public markets and IPO market has been so open in that sense. We just made a $1 billion investment in Haldiram in the last quarter, which is a snack food company in India. It's a 100-year-old family, very stable business, strong cash flows, not impacted by tariffs and things like that, right? So that's just one example. But we've been pretty active, and we do see significant opportunities in the private market too. Okay. In the last year, we invested in Rebel Foods, which is another consumer company, a consumer tech company like Lenskart. We increased our stake out there. So, I think we've been pretty active in the private markets too.
For India as well as China, have you upped geographical allocation to both of these areas or not?
So, about till 10 years ago, we were primarily an Asian investor. And within Asia, outside Singapore, the main market we made a presence in was China in terms of our exposure. And then we decided to become a global investor and set up offices in the US and Europe. So in the context of our starting point, which was in the high 20s in terms of exposure in China, which would by any standards be very, very high, as we had to build up a US and Europe exposure, it was natural for China to come down. And even today, it's fairly significant at about 18% of our overall portfolio. India started off at a lower level, about a decade ago was about 5%. It is now about 8% of our underlying exposure. So it has increased over the last few years as we've seen more opportunities, both for investing, but also for exits.
ASEAN foreign ministers are meeting in the Malaysian capital, Kuala Lumpur, and also making an appearance in the city is US Secretary of State Marco Rubio. JP Ong joins us with the details. At the time when his boss is really upping the ante on tariffs, what's on Marco Rubio's agenda?
Well, you know, these tariffs are also front and center for the foreign ministers who are attending this meeting in Kuala Lumpur. In fact, Prime Minister Anwar Ibrahim of Malaysia, who kicked things off, Sri, minced no words and actually said that tariffs are being weaponized in an increasing fashion recently, with tariffs and export restrictions now being used to pressurize and contain countries, and urging ASEAN to work together more closely and to increase trade. Now, we'll see if it adopts that same firm tone actually when Prime Minister Anwar Ibrahim actually meets with U.S. Secretary of State Marco Rubio later on, and the tariffs indeed will be one of the things they will have to touch on, especially since Malaysia is one of the countries that saw their tariffs actually rise. We also remember it's not just Marco Rubio who's also attending this conference. They will also hold meetings with the likes of Russian Minister Sergei Lavrov and Chinese Foreign Minister Wang Yi. Now, China, of course, we know 2 months ago, President Xi Jinping was in Malaysia where he said they will have to champion and defend the state of multilateralism in the world against some of these unilateral moves by countries like the United States. Of course, this also happened against the backdrop of more tariff letters from President Donald Trump. This time around, we saw tariffs on Brunei rise from 24 to 25%, and the Philippines also the tariffs going from 17 to 20%. The only country now without a tariff letter is Singapore from ASEAN again, but that could easily change. They're facing a 10% baseline tariff. Again, something will have to be done. The Philippines also saying they are working hard to try to clinch a trade deal alongside other ASEAN nations by the August 1 deadline. But again, a tall task because you can see here everyone is facing a new world order with regards to their tariffs and possible exports to the world's largest economy, Sri.
And the window of opportunity is diminishing for a deal. JP, thank you very much indeed for that. Coming up, as the US considers sanctions on Russian oil, will New Delhi continue to buy from Moscow? We will get the Indian energy minister's take on this and the country's domestic pricing picture. Stay tuned. Welcome back. You're watching Inside India, some of the stories that we are keeping tabs on outside of India. Hamas says it will release 10 hostages as part of ongoing ceasefire talks in Gaza. The group calls the negotiations tough, blaming Israel's stance for the deadlock. Key issues remain, including more aid, an Israeli withdrawal from Gaza, and guarantees for a permanent ceasefire. YouTube says it may block more than 24 channels in Pakistan after a court ordered a ban on content deemed anti-state. The move could affect channels linked to opposition leader Imran Khan and government critics. Digital rights groups warn the ban would further erode free speech in Pakistan. And former South Korean President Yoon Suk-yeol is back in jail after a court approved an arrest warrant. Prosecutors are investigating his botched attempt to impose martial law last year, and the request for a warrant was granted on concerns he could destroy evidence. Let's bring it back to the markets in India, and we are about a quarter of an hour or so away from the official market open. Let's give you a glimpse of futures and what they are implying for the market action. 25,533. So little changed, that implies, compared to where we left off for the benchmark yesterday, which was 25,476 at the close. Dollar-rupee exchange rate is looking stable at 85.612. Checking in on the price of oil, and the two indicators are trading around the $70 a barrel mark. WTI 68.33, Brent crude $70.18 a barrel. India's purchases from Russia have been in the spotlight as the country walks a tightrope between sanctions and stabilising its energy sources. Remember, India imports most of its energy needs, and Russia makes up for nearly 40% of the country's total crude imports. US Senator Lindsey Graham says the Senate is moving ahead with a Russian sanctions bill. CNBC's Dan Murphy sat down with India's petroleum minister for an exclusive interview and asked him about that.
I'm a professional diplomat. I spent 39 years in the Foreign Service. I do not, as a matter of policy, react to goings on in the domestic legislature of other countries. To the extent that anybody has to react to it, I think my foreign minister has already spoken to the senator, and don't think I need to comment any further.
So what is your expectation with regards to what happens next, though? Because India imports 40% of Russian crude supply.
Well, let me tell you something. We're a 7,000-year-old civilization. We're a 75-year-old country. And on the energy front, in the last 4 or 5 years that I've been around, under the very mature and decisive leadership of the Prime Minister, we've navigated all kinds of challenges. We used to buy energy from 27 countries in the world. Today, we are buying energy from 40 countries in the world. There was a time when the developments that you are referring to, we are talking about February 2022. A lot of the world, I went to Davos and I was told, X and Y and Z should not be buying energy from Russia. And what was the thing? Russia used to produce a fair amount of energy, and I asked a very simple question, and then I was told by my friends, including from the source from which you are referring to, please buy, but buy cheap Russian this thing. So they placed a price cap. So energy from Russia was not sanctioned at that point. Energy coming through a pipeline to Hungary was not sanctioned. Going through a pipeline to the Far East, Japan, was not sanctioned. So they wanted to put a price cap on the rest of it. And I was not unhappy buying within the price cap. So I don't think that's something that we have navigated the global and energy challenges, and I'm confident that going forward we'll be able to do so again. And as I said, as a trained diplomat, I don't respond to hypothetical situations on what might be.
Minister, I think you'll agree it's not a hypothetical. The allegation is that India is funding Putin's war machine.
Well, I don't think I would put it like that. There's no allegation per se.
We buy 40% of their oil.
Well, 1 minute. We buy 38% from there. We buy 30% from other places. You know something? You know how much oil we buy from the United States?
Well, how is that not funding the war machine?
$15 billion of energy we bought from the United States last year.
How is that not funding? How is that not funding the war machine?
Let me first.
40%.
1 minute. It used to be less than 0.2%. And we are, as I said, we will buy from wherever we can. Our commitment is to the Indian consumer. And if there is an international agreement at any point of time that a particular kind of sale should or should not take place, so far the American position was and has been that you should buy Russian oil within a price cap. And we've been buying within a price cap. So beyond that, I don't think we need to go, because that is a situation. By the way, if people or countries had stopped buying at that stage, the price of oil would have gone up to $130 a barrel. That was the situation in which we were advised, including by our friends in the United States, to please buy Russian oil, but within the price cap. So I think your line of questioning, if I may point out to you, does not seem to be taking that very crucial factor into consideration. So in effect, by buying from Russia, we were helping the global economy stable prices, and therefore we contributed to global stability in oil prices.
In previous interviews, you and I have spoken about how your remit, your focus is on the Indian people. So help me understand, what is the most appropriate price of oil for India's benefit, not just from the Indian consumer's perspective, but also for the investment perspective as well, which is critical too?
Look, my friend, India is today one of the largest consumers of energy. It is probably the third largest consumer. More important, our consumption of oil is growing, or energy is growing up 3 times the global average. Also, we are one of the biggest refiners in the world. We have a refining capacity of 320 million metric tons per annum. It is going to go up to 400 million metric tons per annum or even more. So we are one of the biggest consumers, one of the biggest refiners. We are also a reasonably big producer. I have a company whose CMD is accompanying me here. Whenever the price of oil falls, he starts looking unhappy because he is a producer and exporter. But overall, I can tell you, as an Indian minister, I welcome, including statements by the President of the United States, who wants more and more and more energy coming onto the global market. We are happy with that, because we think when global energy is available in abundant supply, it stops inflation, it controls inflation, and for countries like India, which are facing the trilemma of availability, we have never allowed any shortages to come in, affordability, we have one of the lowest energy prices in the world, plus we take that energy to the economically weaker sections of our society. We provide clean cooking gas to our citizens, something like 100 million people, at something like 8 cents in a day, and to those who are not beneficiaries of the scheme for about 15 cents a day. So for us, global oil prices at the current levels, look, I'm not an oil trader. So what would be a good price? Because this is a game in which what is a good price for me may not be a good price for you. Now, since you come from the United States, somebody telling me this morning, if oil prices go anything below, let's say, the current levels, you will have a situation in which a shale doesn't remain viable. That's not for me to judge. I personally believe that we have today a happy situation that more and more oil is coming onto the global market. Why? From OPEC. They are restoring some of their former cuts. From the Western Hemisphere, from the United States, you were producing 13 million barrels a day. You're adding another 1.6 million barrels of oil to the 13 million you're producing. I'll give you an example of a country like Brazil. It used to produce 3 million barrels a day. They're adding another 140,000. I didn't even mention Guyana. I didn't mention Canada. I mentioned others. So what would be a good price? I'm sorry to give you a long-winded answer. There is no such thing as a good price. I would like to see energy markets, including of crude oil and gas. Gas, there's enough coming on the market. Gas, I think prices will come down. But I think prices have to be stable and predictable so that it is worth the while of the global consumer as also not undermining the investment in the sector, because much as I'm wedded to energy transition, I think transition by definition means you have to survive from the present to the point of transition.
You can always be guaranteed of a robust exchange with Minister Puri, and a great interview from Dan. Let's bring in Vikash Halan now, Managing Director, Corporate Finance at Moody's Ratings. Vikash, thank you very much indeed for joining me. I'm sure you were listening into that exchange. Politically, how challenging is it for India right now to continue buying Russian oil at a time when it is negotiating a US trade deal? Inherent within that deal is inevitably going to be a commitment to buy more US oil and LNG. Is it going to be one or the other?
Thanks for having me. Yes, there was an interesting exchange. Look, India has always been able to balance some of these competing tensions that it has on its hand. And the Russian crude oil, as the minister said, if they did not buy, it would have had an impact on the global market, given the size of imports that India has. Now, with the current environment and the regulations that are being proposed, if they do indeed come into effect, it will be impossible for India to buy the Russian crude. But at the same time, it will mean that you are going to see a significant uptick in oil prices. And if that is the case, you might see, again, an uptick in inflation, which will result in the interest rates not coming down, which is what the administration also wants. So it will be something that the U.S. administration will need to very carefully whether such a regulation is going to be in interest of their own economy. So oil tends to be very sensitive. Now, a trade deal with U.S., first of all, I don't know how likely that is, given that we are now only talking about a mini trade deal. And also oil being part of that trade deal, I have my reservations around how can oil be a part of trade deal, because currently there are no tariff or non-tariff barriers on bringing that oil into India. And also US doesn't have a national oil company. So how will that be enforced as to who will end up ensuring that India is buying a particular amount of oil? So there are a number of different challenges. The oil also doesn't really follow a long-term sort of offtake agreement like the gas. Natural gas do have long-term LNG agreements. So we may end up on the gas front as part of the trade deal. If there is any statement on oil in a trade deal, it will be on a best efforts basis at best.
Understood. Vikash, let's turn to the demand profile. And China and India are the twin engines of global demand. China's oil demand growth, though, is set to peak and may have already peaked by some standards. India's continues to grow and may possibly overtake China's in the longer term. How challenging is it going to be for India to meet that rising demand profile?
Yeah. I mean, look, both countries, it's very interesting, have relied very heavily on imports. And that is why they have been trying to find ways to reduce or control the increase in imports with, of course, with very little success. Now, China is finally succeeding in some ways with the adoption rate of EVs going up, and the part of transportation fuel is not growing as much as it used to. With India, the growth in transportation fuel continues to be fairly high, whether that is because of increase in automotive sales, whether that is aviation. One thing that the government has been very successfully demonstrated is the electrification of railways. Railways used to consume a lot of fuel. And with the electrification, that chunk of demand is now out. The government is also adding a lot of renewable capacity or even thermal capacity to take care of the industrial demand. So out of the three big sectors within the industrial, transportation, sectors. You've got the industrial sector, railways are now somewhat controlled. The transportation one, we are very early in the adoption of EVs in India, but it is something that the government is trying to encourage. If China is an example to follow, you will see with the battery prices coming down, the cost effectiveness of a EV might increase. But again, infrastructure will take time to build. Once it is done, then the ramp up could be fairly fast. But by end of the decade, we expect additional 1.2 million barrels of 1.2 million barrels per day of oil consumption to come in from India, incremental. And therefore, India will need to find a place, as the minister was saying, he wants more energy, and that's bang on that you would want the energy supply to increase. Otherwise, it may end up pushing up prices. Now, with the domestic production scenario, there is very little production in India. India is like 90-95% dependent on imports, and production actually has been declining. With fields that have been producing for the last 30-40 years, we haven't had any major discoveries. I mean, they are talking about further exploration in deep sea, but that if they find something, it'll take 10 years. To come on board.
That said, India has just revised and redrawn its nearly 77-year-old oil exploration and production laws. So perhaps something's going to come out of that in terms of new acreage and prospectivity. But how would you characterize, Vikash, from a ratings point of view, India's national oil companies, from ONGC, Oil India, their business and financial profiles? How well integrated and diversified are they? And ultimately, what is the upshot for their credit profiles?
Right. So India is very interesting in the sense that its national oil companies are actually quite fragmented. So you've got the downstream businesses with BPCL, HPCL, and IOCL, the three refining giants. And then you've got ONGC as the upstream giant. Oil India is smaller and more focused on Northeast. They're not very well integrated. ONGC did acquire HPCL, and it improved the integration to a certain extent. But still, when you compare that to a Chinese national oil company, CNBC, for example, or a Malaysian Petronas, or even looking at Indonesian Pertamina, they are much more integrated. There is a single national oil company in Malaysia as well as in Indonesia, whereas for India, it's fragmented. Now, with the fragmentation, of course, there is exposure to cyclicality, given that refining margins as well as oil prices tend to fluctuate quite a lot, and therefore you're not as insulated or as protected. With the Indian ones, there is also an additional element of government price control. There was a brief period after 2016 where the prices were deregulated, but the prices did come back and in the regulated framework in a way, well, not official regulation, but a degree of price control that the government imposes. And therefore, they are much more exposed. They are also adding a lot of capacity, which means their free cash flow is going to be negative, and the debt burden could go up.
Yes.
But I think the overall credit quality is fairly tied to the sovereign, because we expect the sovereign support to come in if and when they are in trouble. Because
Herein lies the problem. Herein lies a problem, wouldn't you admit, Vikash? Because India's policy governing fuel stability arguably needs now to move in the direction that China's is now, needs to be more market-oriented. And does the government take from the petroleum sector through taxes and dividends? Does that need to be reconsidered and reformed? And how big a ship is that to turn around? Are we seeing the appetite for that kind of reform?
Yeah, I mean, it's good that you brought that up, because it's a very weird combination. We see typically for an oil and gas exporter, the government relies on the oil and gas to provide them with budgetary support. But India is a oil and gas importer, and yet it relies on its oil and gas companies to provide some budgetary support. I mean, it used to be worse because India was, giving subsidies, and it was a budgetary drag. So it's interesting this turnaround that happened, over the last decade or so, where the oil and gas companies are providing. Now, India did introduce GST, but the oil and gas was not part of it, particularly because the state governments themselves rely a lot on these oil and gas revenues and taxes. Therefore, you're right in saying that, could the government do something about this in terms of encouraging the oil and gas companies owned by the government to explore more, increase production? Possibly. But I would love to think that if you actually make the pricing structure or more market linked, then you might, at least on the upstream side,
yes,
you might get more private players go
yes,
in and invest in exploration. We already have reliance.
I'm glad that you raised that, Vikash. And if I can switch from the upstream to the downstream part of the business, refined fuels, petchems, lubricants, is that where the value creation and the value opportunity is? And especially when you look at restructuring efforts at BP unfolding in India with the Castrol lubricants division up for sale, Reliance, Aramco, private equity amongst the potential buyers. Are we going to see more deals in the downstream space along these lines?
I mean, the reason why you're seeing deals in downstream is because that's where the assets lie at the moment. The upstream assets are fairly concentrated and few and far in between. But the downstream, there is a degree of assets. But downstream is not as attractive to me as a upstream would be, given that the upstream is so underpenetrated at the moment. So downstream is fairly well supplied, and we are, as I said, more exposed to cyclicality. Petrochemicals, we are seeing a very structural decline or overcapacity situation that will probably take years to resolve itself. So I wouldn't say downstream is very attractive. If you see some transaction, it could be a strategic shift, or it could be a distress sale.
Understood. Vikash, great conversation. Thank you very much indeed for your analysis. Vikash Halan there from Moody's Ratings. Thank you. Now, Indian markets have opened up and have joined the trading day. We'll look at some of the movers in Mumbai after the short break. We're back in 2 minutes. Welcome back. Indian markets are joining the trading day, and it is a flat beginning for the benchmark Nifty 50 at 25,450. So what's probably holding this market back are the tariff headlines, especially around pharma and copper, and of course, arguably, the optics surrounding the agricultural component of a potential trade deal, as we have been discussing for quite some time now, are looking quite challenging. So that may call into question a full and final deal at this point in time. That's probably going to be kicked down the road until October. So the best that we can hope for is an early harvest, short-term mini deal, depending on how you want to characterize it. Dollar-rupee exchange rate at 85.595. Indian state-owned banks are set to raise over $5 billion through qualified institutional placements of shares in the current financial year. State Bank of India is said to be launching its QIP soon. Government will complete its stake sale in IDBI Bank by October and plans to sell shares of UCO Bank, Bank of Maharashtra and more in this financial year. Let's give you shares of TCS, as India's largest IT services company is set to report Q1 earnings today. Analysts are expecting a decline in both top and bottom lines, attributed to a ramp down in key deals. And we all speak to the CEO and MD of TCS tomorrow on Inside India. Don't miss that conversation. I'm afraid that's all the time that we have today on this Thursday edition of Inside India. Do keep watching CNBC. Dan Murphy is up next with Access Middle East.